pretty good.
Okay. Chapter 6. Cash and internal controls. Okay. What comes to mind when you hear cash and internal controls?
Policies and procedures.
Policies and procedures intended to
Protect assets. Promote efficient operations. Ensure reliable accounting and urge adherence to company policies.
All right, so we think about protecting, preventing. I heard the word efficiency. All of those are correct. You know, when you think about, as we go through this, I want you to think about, especially those of you who have access into the accounting world or have had access in your employment position, but you might also be able to relate this to some other internal procedures. We're going to focus this on cash, but think about other internal procedures that might be prevalent in your employment, you know, that are also in there to prevent, to ensure, and to protect. If you can't come up with anything as an employer, think about it as your own home, and think about probably systems in place and even procedures that you have, and so we'll be able to relate it. Policies and procedures manager use to protect assets, ensure reliable accounting, urge adherence to company policies, and to promote efficiencies. Okay, who's heard of the Sarbanes-Oxley Act? Sometimes abbreviated as SOX. All right, so SOX, this is going to take us back to the result of some, we'll call them shady individuals, dating all the way back to, you've heard me talk about Enron in here and WorldCom. We talked, I think, even about Sarbanes before. I've introduced you to it. But Sarbanes does have a piece in it that's going to require managers and auditors of public companies to document and certify the system of internal controls. Remember, there was some shady accounting going on from insiders of those companies that we just named. And so Sarbanes-Oxley was drafted. This is named by Senator Sarbanes and Representative Oxley at the time. But again, it's going to require that officials of publicly traded companies, to satisfy the SOX requirement, must list the internal policies and procedures that they're using. Section 404 requires that managers document and assess the effectiveness of all internal control processes that can impact financial reporting. Principles of internal control. Establish responsibilities, maintain adequate records, ensure assets and bond key employees, separate record keeping from custody of assets, divide responsibility for related transactions, apply technological controls, and perform regular and independent reviews. Now let's look at how all this is intertwined. We've talked about the impact that technology has had on accounting. And we're going to find how it specifically relates to internal controls revolving cash, but it is shown to reduce processing errors. Okay, if a computer populates these fields throughout certain forms, think of this as an example. It's not going to require someone to go in and manually type in the same information on form after form. Go back and think of entering data and technology going ahead and summing that data. It's not going to require the manual display of mathematical skills. Okay, more extensive testing of records. It's more easy to search data. You know, right now we see cloud-based computing becoming very popular and prevalent in businesses. And it's interesting when I think about, even as a small business, being able to go up, and my company, we're up in the cloud, how I can go up in the cloud and type in one keyword and search our entire database and 20 years of history. Whereas before I'd have to go in and pull physical records and think of not being very efficient here. Crucial separation of duties, passwords, displays, technology now, you might go into an accounting record and it's going to create a digital blueprint of whomever signed in to access that technology. And it's even going to leave a record probably of what that individual did, so that you could be able to identify who was the last person to have access into this file, and that's going to pop up. Increased e-commerce. Okay, I would venture to bet that every single person here has bought something overseas, or at least that originated from overseas, even if you didn't realize it at the time. Limitations. All right, so limitations of an internal control system. And these are found even in a good internal control system. First, we're going to focus on human error. This is going to include negligence, fatigue, misjudgment, and confusion. So despite having a good system, we can find human errors. Now, human fraud. This is going to be the intent to defeat internal controls for personal gain. And remember that human fraud has the triple threat: the opportunity, the pressure to commit fraud, and the rationalization that you would not get caught. Which one of these do you think is the hardest to prevent?
Pressure.
Well, let's just look at back on this one. Human error, human fraud.
The hardest one to prevent, period.
Yes, fraud or error?
Error. Everyone makes mistakes. You type in a number at the beginning, you fat finger and don't realize it, and then you screwed up the whole entire thing.
Okay. But fraud, remember, comes at us from this triple threat. Okay, so you have someone intentionally trying to defeat the internal control. We talk about opportunity, remember, refers to internal control deficiencies in the workplace. So there has to be an opportunity first to exploit. Pressure. Okay, this is going to stress, hey, we can succeed, we need to succeed. There's a family needing taken care of, friends need my help. And as I said, the rationalization that you will not get caught. So let's keep thinking about human error, human fraud. We'll come back and answer that question. Okay, the cost of internal controls. Here's something important. The cost of internal controls must not exceed their benefits. Okay, so just like in general, it's good that your benefits exceed cost. An internal control system the cost must not exceed the benefit. You all right?
Bug.
Threw your hand in the air. I thought I was going to get an amen. All right, be sure you refer to the need to knows. Cash equivalents, and liquidity. Somebody give me an example of a cash equivalent.
Short-term.
Accounts receivable.
Accounts receivable. All right, cash equivalent can also be items in very short-term investments. Okay, money market funds, for an example. Items in money market can be redeemed on a daily basis. So something that you can put your hands on and have immediate access, or at least be in a position where you could have access in a very short period. We talk about liquidity. What am I talking about?
Availability of resources to meet short-term cash requirements.
All right, just think, how quickly can we turn it to cash? All right, an effective system of internal control should protect cash, cash equivalents, and meet 3 basic guidelines. Okay, the handling of cash is separated from record keeping for cash. Cash receipts are promptly deposited in a bank. Cash disbursements are made by the check. All right, go back to this example. If you remember, a few weeks ago, I gave an example of an internal process that occurred over at my firm. Money was deposited into an account that did not belong to us. Now, if you recall how that was detected and how I was able to rule human error is what it came out to be, but a human error on the part of the bank was that handling of cash is separated from record keeping of cash. Okay, that's the first thing that we would have done. Now remember that cash every day is taken to the bank. Every check is taken to the bank. And remember I said we would never accept cash out of the business. That was the biggie right there, is because we would have no cash transactions. You know, it's against our internal procedures for anyone to go up and suggest that the bank give them cash out of one of our company accounts. We would also not pay anyone using cash. Cash, currency, coins, and amounts deposited in bank accounts. This is going to include some savings accounts and also items such as customer checks, cashier checks, certified checks, and money orders. We said cash equivalents, short-term, highly liquid investments that are readily available to cash and close to a maturity date and not sensitive to any changes in interest rates. An example of cash equivalents we could say would be accounts receivable. Now, the goals of cash management are twofold. They are to plan cash receipts to meet cash payments when due, and 2, keep a minimum level of cash necessary for the business to operate. So first, you want to have the cash on hand to meet debt obligations as they are due. And 2, you don't want to keep excess cash lying around just for the sake of having excess cash. Okay, now let's just say that you do work in a business that accepts cash payments. And so now let's go through this. We're going to use a merchandise company and take a look at a graphical illustration of how this all flows. So think about your last trip to the department store. All right, so as you checked out with that day's bargains, you look like a bunch of savvy shoppers in here, so I know you had the bargains. All right, so you took it up to the sales clerk, and that individual rang you up on a register. Now, at the end of that day, they're going to clean out that register. Okay, so they're going to prepare a cash count sheet and send it to the cashier. Now, once it goes to the cashier, what are they going to do?
They're completed with money that they got in the register.
Well, they're gonna prepare cash records, so they're gonna go in and verify that this cash on the register matches the actual amount of cash that was sent to them. And then they are going to prepare a deposit slip and the journal. Now, where does it go from there? You say it goes off to the bank.
Depends on the company, I guess.
Well, once the deposit slip is made, it's going to go off. In some cases, you might have an individual sitting there that would approve that, but its next destination is going to be it's sent to the bank. In this example, we have a supervisor here. We can say that the supervisor, you know, this is not giving us a good flow, but your supervisor could be sitting in here in between the cashier and the bank and ultimately review. But there's going to be a person of review and a person of responsibility. And what we notice here is, how many times have we seen a separation of duty and responsibility? We see it 3 times here. Before the cash ever leaves the building, it's been looked at by 3 individuals or 3 departments. And remember, each department has their own unique responsibility. Now, I would say too, as a separation of duty, you know, you might want to think about having some form of wall set up to where you are preventing communication outside of what is required here. You know, I don't know that I would have these 2 individuals seated right next to one another.
So it's kind of like in the healthcare, like care for the elders. Our accounts receivable, she can take in the deposits all day long. People paying bills and things like that, but she cannot take it to the bank. State law requires it.
Correct.
So someone else has to, it doesn't matter who. It could be someone from maintenance. Doesn't really matter who takes it to the bank and makes the deposit, but she physically cannot take it.
Now, it's interesting you say state law prevents that, but internal procedures, I hope, would be written to prevent that. That is one duty you always want to have separated.
Anytime I took the deposit, I was like, how many times you count this? And I didn't leave the bank until they counted it.
And you got a record from the bank to verify what was going on. That's funny. But that is a good example. All right, so what happens if, here's an example of human error. So it's funny you said you didn't leave without having it checked. All right, now in our cashier, so our sales clerk is up there, and what happens if we notice a discrepancy between the cash sheet that she just ran off the register and the amount of cash that they have on hand? And that is going to happen at times. All right, just note that we have an account here called cash over and short. So in this example, cash register's record shows $550, but welcome. But after the cash is counted, we see $555. Okay, so you see how they would prepare. They're going to debit the actual amount of cash that was in the register. They're only showing $550 of sales. So for the matching principle here, we're going to create this account called cash over and short, and we're going to make up the difference there. Cash receipts by mail. Okay, preferably 2 people are assigned the task of opening mail. Now, this is another common procedure. Whoever is responsible for opening the mail is usually separate from the person who is intended for receiving the mail. So you might notice mail departments, or even in smaller businesses, someone might be assigned the task of first thing they do is go and check the mail and open it. The cashier deposits the money in the bank. So if a check comes in the mail, that person opens the mail and records a record of it, and that check is going to go over to the cashier. The cashier is going to prepare the money for deposit. And then we're going to send it over to the record keeper, and they are going to record the receipt. Okay, so they're going to put it in the accounting records. They're going to open it, they're preparing it for the bank, and then they are going to record it into the accounting records. Cash disbursements. All right, pay attention here. Cash disbursements, especially important as most large thefts occur from payments of fictitious invoices. Unfortunately, there is no shortage of news or examples of payment to fictitious accounts in the accounting world. Okay, so how can we control? Require all expenditures to be made by check. And remember, I just said internally at my company, we do not pay any debt obligation using cash. Limit access to checks except for those who have the authority to sign checks. Okay, so you might have someone internally who is assigned the task of authorizing and putting their signature on the check to make it official. And that's probably someone up in the higher management world, or a controller, someone working in the finance or accounting, the CFO, the controller, the treasurer, or someone else if you're a larger organization that just has that authority. But you want to limit access to checks. You shouldn't have someone in maintenance able to just walk in and any more checks being the computer generated types, but you shouldn't allow anyone from maintenance or sales probably going in and having access to those. And those checks should be separated and put in a controlled environment with only those with the authority to sign having access to it. Vouchers. Does anyone use a voucher system? All right, a voucher system establishes procedures for verifying, approving, and recording obligations for eventual cash disbursements. And 2, issuing checks for payments verified, approved, and recorded obligations. Okay, here's an example of a voucher system. And you'll note the flow of process here. I'll just point that obligation out to you. Petty cash. Does anyone use petty cash?
I'm petty and I don't have any cash.
You're petty and you have
No
cash. All right, petty cash is small payments required in most companies for items such as postage, courier fees, repairs, and supplies. Do what?
I said, and bonuses.
And bonuses.
Yes, they use the petty cash to do pickup bonuses where I worked. So a $25 pickup bonus, you pick up a shift, you give out a $25 bonus, and they use the petty cash, had you sign off the paper, who got it, who actually received it, how much was it, and that's how they recorded it. They call it a pickup bonus. Which I thought was very odd because any kind of bonuses should be recorded on their check, but hey, who am I?
Nice cover. We are videoing. So let's
Can you go ahead and say the name of that
no, let's
company with
keep
the
that
address?
separate. But no, when you think about, going and running to the post office and buying a stamp, or, it might be just the process, not very efficient to go in and have to write a check, for some of these smaller purchases. So we'll have a petty cash system. And here's going to show some accounting for the petty cash fund. Okay, so on November 1st, what are we doing here?
Debiting.
We are debiting cash, or excuse me, petty cash by $75. Do we increase it or decrease it? Increase. And how are we getting that? By crediting cash. So now we're decreasing cash by $75 and we're crediting it and we're matching principal. We're placing that up in petty cash. Now here's Z-marked. On November 2nd, cleaning of LCD panels, $20. November 27th, tile cleaning. Looks like they had some transport of merchandise purchased, delivery expense, and a small office expense for $4.75. Now notice down here, we have all of these expenses are totaled for an amount of $71.30. But notice the flow and the formatting. Each date, it's easy to see the date and the purpose of reducing our petty cash fund. Now, November 27th, here we are, $71.30. Do what?
Said approved by M&M.
Said approved by M&M.
Yeah.
Oh, yes. Well, here's another example. So it's,
Johnny Walker.
Smirnoff, Dan Jack Daniels. But here's an example. Identify 4 internal control weaknesses of this payment report. So we'll look at the company here, Bacardi. So these are all going to be products under Bacardi. Okay, so Bacardi establishes a $150 petty cash fund with M&M as the petty cashier. When the fund balance reaches $19 in cash, M&M prepares a cash payment report which follows. Okay, identify 4 internal control weaknesses from this report.
Shouldn't there be a starting balance on there, according to how much is actually in petty cash?
Well, it's 19.
I know, but it didn't show that as much.
Well, you see it's established with $150.
He didn't sign for one of them, right?
All the
Is that what omitted mean? He didn't sign for it?
Well, it means that it's not there.
Okay. So could that be in here?
Okay, we see the word omitted, so it was not approved. What else?
Then I assume the other one that's omitted is an error
account chart.
because it doesn't say what account was charged, right?
What about the receipt number?
Here's 14 is missing.
The receipt number 14 is missing. All right, that would be one red flag. Now, what happens if I take $19, okay, and subtract it from $150?
So not adding.
What amount? So $131 is going to tell us has been spent, but we're only showing 120. That would be item 2. We just identified that no one signed for receipt number 16. It was omitted. And someone stated receipt number 15 also contains the word omitted, but you see there's no account to show where that money, what account was charged for that $32.
So the answer was obvious things, but we were looking more in depth, looking for. And I'm like, okay.
I just saw omitted twice, I'm like, there's.
All right, let's look
Made it
and
more difficult than what it was.
let's start talking about the bank. Okay, basic bank services, signature cards, deposit slips, bank statements, EFT transactions, checks, and bank accounts. Okay, almost any bank that I can think of right now is going to include these basic services. Okay, usually once a month. Let's first ask this. I've asked this question at the beginning of the term. Who in here reconciles their checking account? Your bank does it for you.
Yes, I have virtual wallet.
Virtual wallet. We'll go back to the errors that we just talked about. Use my example. I have virtual wallet. I am virtual. And errors do occur. Errors do occur. So it amazes me though how many small business owners think along these same lines and don't go back and reconcile. When you think of how many points of contact that your banking account has, let's focus on an operating account. So let's say you have a checking account set up for operations. Even small businesses might have hundreds, if not thousands, of folks that they are writing checks to and who are depositing money into that account. You could have 100 or 1,000 customers. So when you think about the points of contact and how easy it would be for an error to occur. Now, not only the error, let's not only focus on the error. What else should we reconcile for?
So we know how much is in our account.
Well, so that we have good accounting records, I agree. And Wisconsin answer. You're muted.
Better that way.
Thank you. All right, what else might we do? Go back to the two types of fraud, or excuse me, the two types of errors. We had human error, we had human fraud. You should also be doing reconciliation to detect and prevent fraud. Fraud that could occur both internally, which is what we're talking about right now, but also externally. If you're using this virtual wallet that you're talking about, think about data breaches. Think about external threats that you might not even have on the books and who can have access to your account.
I really don't ever think about that because anytime it's ever happened, PNC will shut my card off immediately and then they call me.
It would be very easy though for a bank not to be able to detect that.
Yeah. But I mean, you know, I do look and make sure that like charges. So every now and then I'll go in there and I'll look and I'll see like Amazon charges for 99 cents, you know, or whatever. Those are books. So I double check my transactions. So, I mean, I get what you're saying. It's very important.
It's nice to be able to look at it and be able to detect it as soon as possible.
Sure.
Internally, we reconcile our books every single Friday, I've shared. So that is one of the tasks assigned to me, is that every Friday I reconcile all of our accounts. And hopefully you're doing this internally because I can share example after example of cards that have been detected, cards that have been breached, accounts that have been breached.
Well, we worked for Heartland. And they
And
got
you-
breached.
And what's funny is there's an examples of technology out there that will just run. They know the sequence of numbers that are on your card. These computers are just gonna sit and run various sequences. And at the same time, every time it rings, it's gonna fire one out to maybe Amazon. And it's gonna expect a lot of these just get rejected as bad numbers, but all of a sudden one hits, that thief knows they probably got a limited amount of time that they can hit it with. If they're able to view that you're a regular shopper at Amazon, why would PNC ever detect fraud on a purchase that was done at Amazon?
Right.
Now, if it's something obviously that really stands out, banks have gotten really good about increasing fraud detection and being able to detect. I remember a few years ago, my American Express got hacked, and American Express contacted me, and they had noticed point of sale purchases, point of contact, so I'm there in Jeffersonville, Indiana, Louisville, Kentucky, Lexington, Kentucky. And then all of a sudden, somebody bought a Harley, listen up, in Wisconsin,
I think it was her.
Me.
and somebody started buying custom lady dresses up in New York City.
I know.
History, aren't you?
So American Express detects that real quick. I'll never forget, I had just paid the lunch bill. How can you be in Lexington, Kentucky at 12:30 p.m. and also, because it was a point of sale purchase in Wisconsin, and also be in Wisconsin? So yes, I mean, if it's something that obvious, it could pick up, but if it's tracked your records, it could be pretty easy. And I can tell you that with the increased amount of mobile banking and the use of smartphones, these threats have become even more prevalent.
That's why I don't trust that Apple Pay. Everybody's like, oh, Apple Pay. No,
No.
no, thank
today,
you.
not tomorrow.
Or that, what is it?
That tap.
That chat thing where like, oh, here's $20 for that food you bought me the other day. And then, no, I don't trust that. A girl tried to get me to download it for a bachelorette party. I'm like, no, you can wait till my check gets wrote to you. You're fine. You're hurting that bag for $20. You can hang out.
You go, girls. So you were already right. You were already practicing good internal cash management,
That's my grandpa coming out.
and didn't even realize it. Well, I tip my hat to your grandpa.
He's like, don't trust nobody, especially with your money.
Yeah.
Here's his coffee can. Go bury it in the backyard.
I like your.
But you know what, when we talk about how the bank tracks things, and where my debit card was breached or whatever, and so as I'm going through and I checked mine and I'm talking to the bank about it, there was 3 purchases. One purchase was made by myself, or it was my daughter. The other 2 were made in Ohio, but the bank, I had to argue with the bank to get them to refund the right money back to me, which was from Ohio, but they kept refunding the money where I had purchased in Louisville. So I had to make sure I had to keep filling out documentation to tell them, you are giving me the wrong money back. Like I did this purchase, but these other 2 I did not. So, but they kept refunding the money where I did the purchase.
Did you get the money back from the Ohio purchase too? In
Eventually,
addition to
no.
the other one?
Eventually I got the money back, but they finally took back the money where I had already did the purchase, but they kept giving it back, and I said, I did this purchase, I did this one, but not those 2.
Well, I can give a good example too of predating just before the financial crisis, when there was a lot, there was some more banking regulation that came out of this. But banks are now capped on the amount of non-sufficient charges that they can levy against an account. And I've heard stories where individuals never reconciled until they might have looked at their monthly statement, but at that time they had insufficient funds. And you think about how often you use your debit card.
Mm-hmm.
They hit you every day.
And if you're not looking at it every time you were using it, and this was a big moneymaker for banks. Because once you hit, they could levy $34, $35, $40 against. Now they're capped on the amount they can charge per incident, and then they're capped at an aggregate number that they can't exceed. But if you were not checking that, and all of a sudden, even if you were looking at it every 3 or 4 days, and then all of a sudden, wow, I just reduced my account by $400, or I'm deeper in the hole, it was a little bit harder to argue let's just go back and say pre-financial crisis.
And I always felt those with debit cards and stuff like that, the transactions are smart, You go to swipe the card, if the bill is $35 and you only have $32 in the account, the card should automatically decline.
But it won't unless you set that up for your bank.
Now that's another legislation that passed out of the financial crisis, is now you have to opt out of that. So the bank argued before that they were doing you a service because they would automatically extend credit to you.
Yeah, so like now I have overdraft protection, which what it does is it actually sucks it from my savings account.
Mine, it gives me like 24 hours, and I can either, I have to transfer it manually though. I can transfer it and let's say I go over 20, I can put 30 in my checking, but they won't charge me an overdraft fee or anything like that, as long as I refill my money within 24-hour period from that purchase.
All right, so up on the board, an example of a bank reconciliation. So notice the bank balance, checks and debits, deposits and credits, and then the ending balance. So in the bank reconciliation, you must take into consideration any timing differences. For instance, if you are operating under a cash accounting system and someone comes in and brings cash to you on December 31st, you are going to receive cash. You're going to recognize that cash in that current year. But let's just say you took it to the bank at the end of business that day, and it did not get deposited into your account. Let's assume your bank was closed on January 1st, and it did not get deposited into your account until January 2nd. That would be something, this would be an example of a timing difference that you must adjust for. And any errors. And remember, errors do occur. Just the example I gave of my own firm, I had to do when I reconciled that Friday, I had to make account for, hey, this money that was deposited into your account does not belong to you. It was deposited in error. Now, you want to be sure that you are taking a look. And this is a true statement. The balance of a checking account reported on the bank statement rarely equals the cash balance in the depositor's accounting records. And again, we look at timing differences. These are deposits in transit. Sometimes you might not know if you're in an interest-bearing account. The bank may credited you interest that you hadn't accounted for, and you're only going to account for that. Think of credit cards too. If we're looking at a credit card statement here that you're reconciling, you must go in and tack in any service fees that were charged or the amount of interest that you paid. Sometimes you might have, in addition to deposits in transits, outstanding checks. You might have mailed a check. I just signed them today, and I think they went to probably 7 different states, including Hawaii. So I'm going to have to wait on those checks to be received and then reconciled on the receiver's end. So during that time, I'm going to have an outstanding check that I'm going to show on my books, but has not been deducted from my bank account. Be sure you look at this example, and it's going to walk you through 9 steps in preparing a bank reconciliation. So again, starting with your cash balance at the bank. Add in any deposits in transit. Subtract out any outstanding checks. Adjust for any errors, and this is going to give you an adjusted cash balance. Here, cash balance per book. So this is what we're showing. Add in any collections and interest. Subtract out any uncollectible items. Adjust for any errors, and again, this is going to give you an adjusted cash balance. Following those 9 steps, you should see a balance on each side. Okay, another example for your view on Gucci. And from a global view, okay, internal control purposes are fundamentally the same across the globe. So when you look at the needs, the threats, we're going to find those same reasons and threats all across the globe. All right, for the control of cash, we're going to see, for the most part, very similar examples and definitions under United States GAAP system and the International Financial Reporting Standard. And bank activities as controls. Now, earlier we were talking about professions. Again, because of the increases in technology, because of some of these more increase in global demands, more access to accounting or more frequency of accounting transactions thanks to cards and e-commerce. Okay, technology has driven a global demand for banking services. To the extent feasible, companies utilize these banking services as part of their effective control procedures. All right, real quick, we always end with the global view. And as you hopefully have figured out now, I always throw a ratio or 2 in at the end. Okay, days sales uncollected. Why would someone want to pay attention to how many days that sales have not been collected?
To estimate how much time is likely to pass before the current amount of accounts receivable is received in cash.
Indicates how much time is likely to pass before we receive cash receipts from credit sales. And we can solve this by taking accounts receivables, dividing by net sales, and multiplying by 365. And why would this be important? Who doesn't like to get paid? You've never met someone that doesn't like to get paid. Well, think about this for the business. In order for an item to appear on accounts receivable, what must happen first?
Receive.
Well, no, before we recognize it as an accounts receivable,
To make a sale?
we must have to have achieved whatever was necessary for us to earn that amount. So if I'm a service-based company, someone has come to me for a service, I have provided that service, and now I have issued a bill and I'm waiting to be collected. Okay, in that example, that person came to us and requested that we provide a service. They engaged us. We provided that service. Now, in providing that services, did we use capital? Yes. We used human capital at least. Someone had to meet with them. someone had to do the service. It's accounting season right now. You went to your accounting professional and you said, hey, Mr. CPA, will you do my taxes? He said, yes. And hopefully by now, he's done them.
You know. You better go get you some TurboTax software real quick.
Yes.
So that person though, and that tax professional used their own manpower. They used maybe a support staff. They paid rent on a building. They acquired software. They invested a lot of money into being able to provide that service. So yes, they tied up the capital. And now they're only going to benefit from once they get paid. So this is a ratio that's heavily looked upon and tracked and constantly discussed and reviewed on how we can increase efficiencies here. And just remember, what's that quote again? Never met someone that what?
Don't like anything.
Doesn't like to get paid. Any questions? We good in Wisconsin?
Yeah.
We good in Indiana?
Yep.
All right, let's take a break.